We're analyzing Altria, stock ticker MO, to see if it's a dividend king on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Altria. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Altria for your portfolio. Before we get into these valuable metrics, let's understand Altria's stock performance. Right now, Altria trades for $45.53 per share. In the last year, their stock price is down 7%. In the last 5 years, Altria's stock price is down 22% overall. In the last 10 years, their stock price is up 24% overall. They're compounding at 2% annually. Going back prior to the global financial crisis, Altria's stock price is down 31% overall. This sharp decline in 2008 came from the spinoff of Philip Morris. Altria Group contains Philip Morris's operations in the United States, whereas Philip Morris, stock ticker PM, operates internationally. Adjusting for that split, the company's stock price would be up over this time, and Altria is a dividend king. They've raised their dividends for each of the last 53 years. Right now, Altria has a huge 8.2% dividend yield. That's one of the highest yields in the entire market, and they have this amazing track record to back it up. But is it safe, and does the company look cheap right now? Altria is trading $5 above their 52-week low. They're only $7 below their 52-week high. Under 1% of their shares are sold short. Altria is a very big business. They have an $80 billion market cap. To learn more about the company, Altria comprises Philip Morris USA, US Smokeless Tobacco, John Middleton, and Helix Innovations. It holds a 10% interest in the world's largest brewer, Anheuser-Busch InBev. Through its tobacco subsidiaries, Altria holds the leading position in cigarettes and smokeless tobacco in the United States, and the number 2 spot in machine-made cigars. The company's Marlboro brand is the leading cigarette brand in the United States, with a 43% market share in 2022. Altria holds a 52% stake in cannabis manufacturer Cronos. It recently exited its strategic investment in Juul Labs. We'll see that write-down reflected in the company's financials in just a little bit. Altria owns the brands Marlboro, Black & Mild, Copenhagen, and Skoal. The company traces its roots back to 1822 and is headquartered in Richmond, Virginia. Now let's dive into the numbers. Starting things off with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. These business returns are captured here by return on capital. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in margin of safety based off the overall quality of the business. Altria's returns on capital have skyrocketed over this time. They've increased consecutively in all 5 of these years. They earned 48% returns on capital in their most recent fiscal year. Averaged out, Altria's earning 34% returns on capital in a given year. These returns are nearly 5 times better than an average business. This is a massive check, starting things off on metric number 1. Next, for metric number 2, we want to back up these high returns with growth in the business. We're looking for 5-year revenue, net income, and free cash flow growth. This metric's all or nothing. All 3 of these have to be up for this to be a check. We'll be including their numbers up until today. During this time, Altria has grown their revenues by 5%, so slight revenue growth. Their earnings were positive in 4 of these 5 years. In 2019, the company took an $8.6 billion loss. That was due to its investment in Juul Labs. The company's earnings then did rebound. However, they are still down over this time. Their earnings have declined by 20%, and Altria's free cash flows have declined by 6%. Because their earnings and their free cash flows are down, this is an X on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years. By looking at the company on a per share basis, we get a better perspective of the returns going to an individual shareholder. Their earnings may have declined over this time, but Altria has actually bought back 5% of their shares outstanding. These small share buybacks are likely good for long-term shareholders in the business, but they're going to be outpaced by their decline in their earnings, meaning this is still an X on metric number 3 for Altria. Next, for metric number 4, we're looking for free cash flow per share growth in the last 5 years. This is going to be a similar situation in that their free cash flows have declined during this time, and Altria has bought back shares. However, we're going to get the opposite result here. Their share buybacks are slightly outpacing their declines in their free cash flow, meaning this is actually a check on metric number 4. Because of their share buybacks, their cash flows per share have increased, meaning so far through our first 4 metrics, we're split evenly. We have 2 checks and 2 X's for Altria. But there's still one vital piece missing. You might think nailing high returns on capital and having growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. In metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow Altria has produced in their last 5 years. Altria has decreased their net debt throughout this time. They ended their most recent fiscal year with $22.6 billion in net debt. Right now they have $21.5 billion in debt, so they're continuing to pay this down. And in the last 5 fiscal years, Altria has produced $40 billion worth of free cash flow that easily supports the company's net debt load, meaning this is a big check here on metric number 5. Relative to their cash flows, it looks like Altria is using an appropriate debt load. Before we get into the first of 2 different ways to value Altria, it's time for our bonus. As our bonus, we're looking at Altria's dividend profile. Altria is a dividend king of 53 years. They're a member of the S&P 500, and they've consecutively increased their dividend throughout this time. In these 53 years, they've raised their dividend 57 times. And right now, Altria pays an 8.17% dividend yield. That's one of the highest dividend yields in the entire market. This is a high dividend yield, let alone for a dividend king like Altria. But people make mistakes all the time by blindly chasing dividends, so it's important to look at the underlying fundamentals supporting their dividends. For Altria, we want their free cash flows to cover their dividends in all 5 of these years, and that's been the case. While Altria pays out a high percentage of their free cash flows as dividends, we learned the company is highly cash flow generative and it doesn't appear to be overly levered. No surprise, Altria has continued to increase their dividends throughout this time, and they've grown their free cash flows per share. While this is a snapshot of their last 5 years of performance, and it's no guarantee for the future, Altria's dividend looks to be well supported right now. The big metric of them all, metric number 6, we want Altria's average 5-year free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this provides a slight risk premium to the yield of the 10-year treasury, and it's the first of 2 different methods we'll be using to value the company. Right now, Altria has a $102 billion enterprise value, which takes into account both their net debt and their market cap, giving a perspective of Altria similar to it being a private company. We learned in the last 5 years, Altria produced $40 billion worth of free cash flow, meaning they produce about $8 billion of free cash flow in an average year. When that's divided by their $102 billion enterprise value, we get a 7.8% average free cash flow to enterprise value yield. On a current basis, Altria produced $7.95 billion worth of free cash flow in their last 12 months. When that's divided by their $102 billion enterprise value, that gives us about the same yield, 7.8%. Both on a current and an average basis, this is coming in a few percentage points above the risk premium we'd be seeking. This is more than double the yield of the 10-year treasury. This is a big check on metric number 6 for Altria. Don't just run out and go buy the business. We want to come to a more concrete estimate of a fair value per share for Altria. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Altria, which takes us on to using a discounted cash flow model to come to an estimate of their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Altria has not been that predictable of a company in its past, especially with some botched investments in its most recent decade. Either way, we're starting with an average of their 3-year free cash flows and using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not going forward. Assuming Altria grows their average 3-year free cash flows at a rate of 3% annually for the next decade, then assuming that these decline to growing at 2% annually for the following decade, we won't be adding in the company's tangible book value because that's skewed based off how the accounting is done for their share buybacks. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for, in addition to his margin of safety requirements, at today's valuations, it looks like an estimate of Altria's fair value per share is around $33.50. That's down about $12 from the company's current stock price. There are some key factors to be mindful of. Again, Altria has had a low degree of business predictability in its past. That may also be the case going forward for the business, which can skew some of these assumptions. This discount rate of 15% 8% would be an estimate of total returns to shareholders based off the company's cash flows. It would already be including their 8% dividend yield. So in this case, their stock price would not be appreciating by that full 15%. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Altria, but we have to address something first. We've covered the quantitative by looking at the numbers, but the qualitative aspects of this business are just as important. What are they? Starting with the qualitative factors supporting a potential long thesis. Number one, relatively low capital requirements allow the company to return significant capital to shareholders in the form of an 80% stated dividend payout ratio policy. That accounts for that high and growing dividend yield we looked at earlier. Number two, Altria has kept its options open. It has a broad suite of cigarette alternatives in its portfolio that should ensure it holds a leadership position in whichever categories are victorious in attracting smokers to new products. Number three, the US market, while mature in volume terms, is a highly affordable one relative to other developed markets. This leaves headroom for price increases for many years to come. But we'd be remiss without covering the negative aspects of the company as well. Looking at the qualitative factors supporting a potential short thesis. Number one, with cigarette volumes in secular decline, multiple alternatives are emerging, limiting the scale and profitability potential of each emerging category. Number two, the FDA appears to have taken a more aggressive approach to cigarette reduction in recent years. It's examining a ban on the use of menthol and a lowering of nicotine in cigarettes. Number three, as a US pure play, Altria lacks exposure to some of the emerging markets in which total tobacco consumption is increasing, leaving it exposed to the secular decline rate that's estimated to be about 5% annually. Altria just recently closed its $2.75 billion acquisition of Enjoy Holdings, which is another vaping startup. They also reauthorized a $1 billion share repurchase program by the end of 2023. There you have it for a balanced perspective of some of the qualitative aspects of the business. Now it's time for our final rating. In analyzing Altria, stock ticker MO, even though the business isn't growing by much, their reinvestment earns huge returns on capital. Altria has bought back 5% of their shares and look to be continuing to do that into the future. The company generates a lot of free cash flow relative to the debt that they use, and they have a fixed policy of returning 80% of that as dividends to shareholders. Again, they've increased their dividends consecutively for 53 years, and they pay a monster dividend yield of 8.17% right now. While there are ESG concerns around Altria, they're an asset-light business that's focused on returning capital to shareholders. It's worth reiterating this analysis is not financial advice. When we looked at two different ways to value Altria, Altria looks potentially attractive on their free cash flow to enterprise value yields. As we performed our discounted cash flow analysis, at today's multiples, if you believe those assumptions and you want that 15% rate of return, it looks like an estimate of Altria's fair value per share is around $33.50. Altria last hit that stock price during the market crash in spring of 2020, so you'd want to be patient as you dig in and research the business. Looking at all the factors of our analysis, Altria looks like a strong candidate for further research. Again, this is not a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Altria in the comments below, and let me know what business you want me to look at next. Thanks for learning about Altria with me, and have a great day.